Welcome to the last in our Ardenwood Presents 3-month webinar series on the timeless blessings of planned giving. Today, we are presenting an overview of charitable giving. I'm John Mitchell, and I serve as Executive Director and CEO of Ardenwood here in San Francisco. Thank you for joining us today. Before we begin, it might be interesting for you to know that almost 2/3 of Americans believe that having a will is somewhat or very important, yet only 1/3 to a half actually have estate planning documents. Think of it. Without good estate planning, a considerable portion of our estate will go to the government instead of to our loved ones and the charities and nonprofit organizations we feel and care deeply about. Good estate planning is intentional, intelligent, effective, and loving. Ardenwood is just one of the charitable and nonprofit organizations we hope you'll consider as a beneficiary of your estate. Donations are invaluable to our work here, and your contributions support our Christian Science nurses' education and care services, as well as events like this one. So your gifts make quite a difference. Please be in touch with us with any questions. Our contact information will appear at the end of this presentation. Finally, the content shared today is only informational and is not intended to be legal advice. And now, let me introduce Rick Bailey, who will give today's presentation and answer questions during our Q&A webinar on Thursday. Rick Bailey is the founder and chairman of Camus and is one of the most highly renowned estate planners in the United States. As a certified financial planner, or CFP, with a master's degree in accountancy and taxation, as well as a Juris Doctorate, or JD, think lawyer, Rick Bailey is a highly valuable asset to private clients, CPAs, attorneys, financial advisors, and life insurance professionals for his expertise in advanced estate planning and case design. Just as a reminder, you can submit questions using the Q&A icon at the bottom of your Zoom screen. And now, let's hear from Rick.
Thank you, John. I appreciate it. This is one of my favorite topics because of how much good it can do. As we talk about legacy planning, it really comes to the fact that you can do so much good, not just for your family and yourself, but for the charities that you really want to support. So as we talk about this, I want to build a framework here or a foundation for our charitable planning discussion. As you start thinking about your planning, we look at it, we want to make sure your planning focuses on taking care of you and your spouse, take care of your family, but now think about all of the other good that you can do as part of that legacy plan. Who else can you benefit? And, we look at others, we look at charities, but really it's broaden your scope. There's organizations like Ardenwood that operate because of the generosity of those that are helping. Can you do more? And we want to talk about not just can you do more, but also really look at how best this fits into your plan. And we talk about this a lot. All of your legacy plan is based off of your goals. Whether it's, part of your retirement plan, long-term care planning that we've talked about, all of this comes into your plan should really be a continuum of planning based off of covering your life, your spouse, your kids, and then think about as you put into your goals, how do you pass on more? How do you pass on the things that you care about and really protect the things that you care about? And that's where charitable planning, I think, really does so much good. We've talked about leveraging and really stretching your dollars. But if you think about what we're trying to do, we all have a finite amount of funding, our income and our assets, that money that we have, it's there to take care of us and our needs. It's there to take care of our family. And now start thinking as you go beyond in that legacy plan, how can we use those dollars in a way to do more? And so we talk about as stretching your dollars, leveraging, whatever it is, we want to be using help you use your money better. Part of that is looking at how we can diversify income. So if I look at most people, their money is going to be, potentially taxed today or taxed sometime in the future. And one of the buckets that we always tend to forget is, can we create tax-free? And so when we start talking about other ways to stretch your money, part of that is making sure that we stop the leaks in the bucket. So not only diversify across and fill all three buckets, but think about that big leak in the bucket. Is Uncle Sam taking that money out, either in income, estate tax? We're dealing with inflation. So those leaks in the bucket really are, problems that we can overcome. But if we can design your plan so that you can keep more of your money, now think about the good that you can do. And there's things that the government can do. There's things that charities can do. But I'll tell you that the reason I like charitable planning so much, charities can do so much more with the money that they're given than the government can. So think about that money that we save, can we reposition that into doing better? And part of that is doing better during your lifetime. Some of that is doing better when you pass on. All of this comes back to your legacy planning. We've talked about this in prior webinars, but the legacy planning goes beyond the just documents. You need the documents to lay out what you've decided. But legacy planning is taking care of you and your family and your favorite charities. And then we put that in the documents to show everybody else what that plan really is, so that if you're not there, your plan happens. But there again, I don't like the word estate planning. I don't like to say it's just wills and trusts, but it's the legacy that you're going to pass on, the legacy that you leave behind. And it's the whole continuum. It's now and into the future, and taking care of the goals and objectives that you want. Of course, we've talked about long-term care. And I want to make sure that we keep this as an issue that we address, that we make sure that you're taken care of during your lifetime. So before we start moving money off to our charitable causes or planning to move things to the kids in the future, that you're taken care of. That's part of the plan. Part of the plan is making sure that you're taken care of now, and how you want things distributed in the future happen. So I'm going to talk about life insurance, and you're asking why are we talking life insurance when we're supposed to be talking about charitable planning? I think this is a great tool and a great strategy to accomplish taking care of you and moving things to charity in the right way. It's just, there again, it's a tool. Life insurance is a tool, probably one of the more misunderstood financial tools, but there again, a way that we could potentially stretch your dollars. So when we start with this type of planning, we look at what are the assets that you have? What are your assets? What are your income? Making sure that we look at how they're being used now. And can we reposition that into something a little bit better? Not all of it, but a portion of it always is what we're looking at. So if we take some of that income or your assets and we move it into life insurance. Now let's stop there. I can tell you most people, when I say life insurance, they think about here's something I pass on to my family or whoever at death. But I want to talk a little bit what's in it for you prior to death. And if we can build that cash value inside of a life insurance policy, this is something that is useful because the tax code allows us to grow that cash inside of the life insurance policy tax-free. Think about that. If you put $100 into that policy, that $100 now can be growing tax-free. Income tax-free. Now, what's in it for you during your life? If we've set this policy up correctly, you're going to be able to pull the money out of that policy to use it for whatever you need or whatever you want. So if we put some of that money into the life insurance policy, and you need additional money for retirement income. Now you can take that money out tax-free instead of taxable like an IRA or a pension would be. And it wouldn't, tax-free means maybe your Social Security doesn't get taxed. So there again, tax-free can be a great way there again to stretch your assets, stretch your resources. What can you pull it out for? Retirement money, what if money. Nobody's there telling you how you can use it or what you can use it for. It's up to you. You can use it for long-term care, take trips, make gifts to the kids. There again, you decide if you want to use it, and if you want to use it, how you want to use it. But it's for you during your lifetime. Now, there's always the death benefit portion of the life insurance policy. This is where I want to make the jump into charitable planning. So now you've taken some of your money, let's say it was a CD or an annuity, something that you may not need during your lifetime. And you put that money into the life insurance policy. Now at your death, you can split that death benefit and say a certain percentage of that goes to your family. And the remainder of it, the remaining percentage can go to charity. So it's a way for you to maybe provide a bigger gift to an Ardenwood or other charities that you're involved in. But there again, it's designed to be a very flexible planning tool to take care of you during your lifetime. Then at death, go ahead and add to your legacy that you're planning or that you've already designed, but you can now maybe give more to charity than you had originally planned on. So it's a great planning tool. As we move into more of what I'll say is the nuts and bolts of charitable planning, let's take a step back and think about that legacy that you're going to pass on. And I had somebody put it to me this way. When you're doing your legacy planning, you're going to plan for your retirement, for the needs that you have during your life. If there's even $1 left over, that's going to somebody else. That's going to your family, that's going to friends, or that's going to go to charity. But you're going to decide how to move those assets into the rest of your legacy plan. Now, as you start thinking about that, do you want, number one, to support charitable giving? And we all have that opportunity. It's now when and how we do that is really up to you. What I will tell you is back to the tax code, because so many things revolve around taxes. The tax code is designed for charitable giving. There again, Uncle Sam knows that there's things that charities do, the good that charities do. Government can't cover that. And so they want to encourage everyone to give more and more to charity as it fits into their planning. As I look into, who charitable planning is for, of course, it's for those that are charitably inclined, whether it's, giving money to your church while, every month, every week, every year, giving it to other charities that you're involved in. I would say the majority of people I meet with are very charitably inclined. They want to help the charities that they're involved in. Now, there's times where you're going to be selling an asset and you want to do it more efficiently. And more efficiently means probably paying less in income tax, more to you and your family. And so that brings in charitable planning. So a lot of times, even if somebody's not charitably inclined, but they want to reduce their taxes on the sale of an asset, that brings us right back into charitable planning. And of course, there's other times where we want to reduce income and estate taxes on an annual basis. There again, brings us right back to the same point of charitable planning. So charitable planning is a win-win scenario. It's a win for you. It's definitely a win for the charity. And if you think about where the money's coming from for a lot of these strategies that we're going to talk about, it's less money to Uncle Sam while you're putting money into places that you care about. So if you start thinking about, and I get this question, when should I give to charity? When's the best time? And I really say it's now, later, in the future, at death, all of the above. It's when it's right for you. And so I have people that do big gifts at death, and they give, more, I'll say more of a moderate gift as, each year during life. I have people that just, have retired and realize they don't need as much money for retirement, make big gifts then. It really comes back to the when is up to you. The how is up to you. What we want to go through today is how best that you can do it. And it's really giving you the different, options. The more options that you have in this type of planning, it's going to create a better opportunity for you into the future. So if you start looking at this, let's start with some easy stuff. And I would say the easiest way to give to charity is to pull the checkbook out and write a check, or in today's world, transfer money from your bank account. You can make a direct gift anytime you want to any charity that you want. Now, anytime that you're doing that kind of giving where it's a direct gift, the tax deduction, if that matters, is a dollar for dollar deduction on your giving. Now, can we do more? And so I want to start from easy to a little bit more complicated. A donor advised fund is a great way to start creating a charitable legacy. So think about what I'm going to show you here is most of the time we're giving it in smaller chunks. Now I can say is maybe you've got a big tax year. And between now and the end of the year, you decide you would like to create some more tax deductions. Well, we can go in and say, let's take all of that charitable giving that you would do over the next 3 years, and let's put all that into a donor advised fund today. And so we're going to accumulate more money into the donor advised fund that we're going to give out to charity over time into the future. So let's look at that in a little bit more detail. So you'd look at it, you've got your cash, investments, savings, wherever the charitable donation is going to come from. And you decide you want to create a bigger charitable gift this year, a charitable deduction, and you don't know where it's going to go. And it's surprising, and I say that for a reason. I had an opportunity this last year to work with a very young couple. And he just happened to be in a business where he got stock options that they wanted to start doing more. And as I talked to them, they were given money to their church. They were given money to the school that their kids go to, but they wanted to do more. They didn't know what to do, how to do it yet. So what we said is, let's set up a donor advised fund. So they took a large chunk of money and wrote a check and put it into the donor advised fund. What that gave them was, number one, yes, they got them a tax deduction. But two, now it set them on their charitable giving journey. Because they knew over time that they would now, as they figure out what charities they want to be involved in on an ongoing basis, they had a fund already set up. If you think it's a separate account. You've got your checking account for home, you might have your checking account for business. Think about this now, you've got your checking account for charitable giving. And the only rule that we have is the money in that separate account for charitable giving has to go to a 501c3 charity, a nonprofit tax exempt organization. So an Arden would. So in this case, as I talked to them, and I said, now, as you go forward through the years, start involving your kids in your charitable giving. Have them help you decide what charities are important to the family. So it could be Arden Wood, it could be the kids' school, it could be, some of the sports programs or other out of school activities that the kids are involved in. But it really allowed them to do more, especially at a young point in their life. So if you think about this, a donor advised fund, is a charitable fund that allows you to give that money out over time if you need to. And so there again, the money is going to go to charity, but we put that fund together today. Now we give that out as you find the charitable causes that you want to be involved with. And so this can happen at a younger age, like it did with the clients I was working with. Could work with somebody that's older that just wants to, put this fund in place and have kids and grandkids help be involved in the charitable giving. There again, help your kids and grandkids expand on opportunities to do good outside of the family, outside of themselves. And it's a great opportunity, and it's a good starting point for the bigger charitable giving. Now, as we move forward, the Charitable Remainder Trust, I think, is a great tool. And I would say early in my career, I saw the Charitable Remainder Trusts were being used a lot. I've worked with a lot of clients that have done Charitable Remainder Trust. Therefore, I'm going to say about a 10-year period, it just disappeared. I don't know, I can't really put my finger on why, but now it's back. It's really come back over the last few years as a great opportunity for more clients to do. And if I look at the basics of a Charitable Remainder Trust, and we'll look at the mechanics of it, think about setting this up. So think about the charitable remainder. It's a box. And we get this box, we open the lid. Now we're going to put, assets into this box. Could be cash, it could be, stock from a business, it could be rental property, anything that we want to sell. So it's not going to be your personal home. It's not going to be your retirement account. This is assets that we want to sell. And a lot of times we want to sell it tax-free. We want the tax-free sale. We don't want the big, we don't want the tax man showing up looking for a big check. And so we want to do this in a tax-free nature. What I like about the Charitable Remainder Trust, now we build this box, we put some assets into it. Now you get to receive income over your lifetime, or we can set it up for spouses over a joint lifetime. We can do it for a set number of years, but you decide how long that's going to be. And you can create income back to you. And I like to think about that income. Think about that as your charitable pension. That's a set amount of money every year that you're going to live on or receive back that you can use for whatever you want. But there again, if you want it for a joint lifetime for spouses, that's a pension income they can never outlive. When they set up the Charitable Remainder Trust, that's going to generate a big tax deduction in most cases. And we're using that tax deduction to offset other income. And we'll talk about that in just a minute. But here's what I like. And here's what I like for charities like Ardenwood is that charity, when you pass away or both spouses pass away, at the end of this trust, when you've gone, whatever's left in the trust goes to charity. And it can be one charity, it can be multiple charities. You can change the charity throughout the time of this trust, but you really get to move what I tend to see larger gifts to the charities that you want. But, and here's the big but, you were taken care of during your lifetime. So it creates a win-win scenario. So let's look at the details a little bit better. So here's the best part of this. When we get into this kind of planning, we're there again, this is your legacy plan. So it's your legacy plan. You're going to be the one to help design this charitable trust. This charitable trust, the only people that matter would be you or you and a spouse or you and the kids, but it's based off of your goals, your objectives, what we're trying to accomplish. When we design this trust, we're only talking to you. The charity gets no input into this. And I'll say the IRS doesn't get any input. It's just us talking how best to take care of you and your goals. Once we have this trust set up, and we'll talk some of the details, the first thing we have to do is transfer the property into the trust. So let me give you an example to think through on this. I was working with some clients out of Oregon a few years ago, and they had bought some rental property in Oregon, and they were getting up in age to the point that they didn't feel like they could take care of that property anymore. So they were going to have to sell that rental property. It just was too much. But they had held on to it and held on to it for several years because they knew if they sold it, it was going to generate a large tax back to them that they weren't ready to pay. So we set up the charitable trust for them. We transferred the apartment complex into the trust. And here's the best part of the charitable remainder trust for this type of a client. They can now sell that apartment complex income tax free. And now inside the trust, which they can be the trustee and control everything, they can reinvest the proceeds from that sale into other investments that don't take the time and effort of maintaining a rental property. So now if you think about it, let's stop there. We've taken an asset that needs to be sold. And, there again, elderly clients that, weren't ready, weren't in a position in life to be taking care of that rental property. Needed to be sold. We sold it tax-free. And now we reinvest that into, stocks, bonds, mutual funds, and, annuities, whatever the client is comfortable with. Now, when we do that, set up that trust, we're going to identify at least one charity. And that charity designation can be revocable or irrevocable, meaning you get to decide, is this something you want to have the power to change over time, or do you want to set it in stone? Most of the people I talk to want to have some control, and they keep it as a revocable designation so that they can change that to one or more charities over time, if that's what they want to do. Now, when we've do this, it's going to generate a charitable deduction back to our client, the donor, you, and you can write that off on your income tax return. If you can't use it up in 1 year, you get to roll it over for a total of 5 more years. So a total of 6 returns. But here's the part that I like for you, is this trust is going to pay back an annual, semi-annual, or monthly payment to you, whatever you want to set up, based off a percentage that you decide up front. So when we put the trust in place, you decide this is going to pay you back, 5, 6, 7%, whatever it is per year. And once you set this, you can't change that percentage. But now it's going to pay back that percentage of income every year to you for your life, joint lifetime, set number of years. But there again, if this is a pension, and that we need this as lifetime pension kind of income, let's set it up for your life or joint lives. And that money now is there to take care of you. If it's set up for your lifetime or joint lifetimes for spouses, whatever is the end of the trust, whatever's left in that trust bank account now goes to charity. And the charity, is benefited. You were taken care of during life. And it creates a great opportunity to be working, to increase what you're going to give to charity. But we take care of you in the process. This is all focused on you and what your goals and objectives are going to be. So it's there again, making sure that we always focus back to your goals. Now, let me give you a couple things that we have to make sure we're aware of here on a charitable remainder trust. Number one is this has to happen. The property needs to be put into the trust before the property is sold, but really before you sign any sales documents. So I was working with some clients a while ago. They had already they were in a sale. The sale was already documented. It was going to happen in a matter of days. I said it was too late, to do this kind of a plan. So we want to make sure we look ahead in time and do the planning that we need to. The other thing that we have to be aware of, if there's debt on that property, on the assets we put in the trust, we can't do a charitable remainder trust. So there's a few rules we have to follow here. But this is something that the Internal Revenue Code, the tax code encourages. Congress encouraged it when they put it together, and it's been around for a long time. There again, we wanted, Congress wanted to make sure that charities get the money that they need to do the good that they're doing. Now, charitable remainder trusts are great, but there again, there's limitations. So let's talk about the exact opposite to this, and that's a charitable lead trust. Very similar, but we're accomplishing a few different goals here when we talk about a charitable lead trust. With the charitable lead trust, we're going to do the same thing. We're going to put cash, investments, real estate, business asset, whatever, and we're going to donate that to a charitable lead trust. Now, where this one will work, where a charitable remainder trust doesn't, a charitable remainder trust, we actually move the property in and do the sell inside the trust. With a charitable lead trust, we don't have to sell the property inside the trust. So we can actually put cash in, other investments. It's a little bit more flexible from what we're putting into the trust. But here we got something that is going to be, set up a little bit different, achieving different goals. But here's the goal that I probably like the most for this. There again, it's going to create a big tax deduction if you need it. But here's what an Ardenwood or another charity really likes out of this type of planning. They're going to get the income that's generated from this. So that, think about the charitable remainder trust. The charitable remainder trust had that pension income for, the life of the donor or joint donors' lives. Here we set up a set number of years. So we set up the trust for 5 years, 10 years, 15 years, however long you want to set it up. But during that, say, 10-year period, the charity receives the income. The charity or charities, you can have multiple charities here. But now the charity knows it's going to receive a set stream of income for the next 10 years. That 5, 6, 7%, whatever you want it to be, that can be set up to where the charity knows that money's coming in, and the charity can now use that, budget that in to do the good that they do. At the end of the trust term, whatever's left in the trust comes back to you or your family. So there again, I've worked with clients that do this, and what can happen here, think about setting this up as a 55-year-old, knowing that you're going to retire at 65. So now for the next 10 years, the charity is going to get that income stream out to you to do the good that the charity can do. And at age 65, when you retire, all of this money comes back into your account for you to use for your retirement. They're again creating some win-win scenarios. So let's look at the mechanics. There again, sets up very similar to the charitable remainder trust. We're talking to you. What are your goals? What are your objectives? What do you want to accomplish? Once we have that charitable trust figured out for you, and we get it documented, put it in place, now we transfer in the property. This can be a check. It can be a transfer of cash, investments, whatever you want to put in there. Now that's going to generate that charitable deduction back to you. There again, you've got 6 tax returns to use up that charitable deduction. And the trust will reinvest those assets inside the trust. Who's controlling that? You as the trustee, if you want to be. If you don't want to be, you can hire another trustee. But here's what the charity likes. This is the win for the charity. For the next 5 years, 10 years, 20 years, whatever you decide, that charity is going to receive a percentage of that trust investment. So 5%, 7%, 8%. Usually I would say it's going to be less than 10% would go each year to charity of the amount of investment that you put into the trust. And then at the end of that 10-year period or whatever trust term, the remainder comes back to you or back to your family. So it creates an opportunity for you to do, I like to see the good that it does. So what I hear from a lot of my clients that do this kind of planning, they get to see the good that their money's doing. Versus a charitable remainder trust, think about that. It passes to the charity after your lifetime in most cases. Yes, your money's going to be doing good, but you don't get to see it. Here, you get to see the good that your money is going to do. And so they're both great techniques, but they kind of hit just a little bit different. And so when I look at charitable planning, there's other opportunities. There's foundations that we can set up. All of this is designed to help you decide how you want to do your charitable giving, but it's based off of you. And so it comes back to your goals. As I bring this back into kind of pulling it all together, legacy planning is based on you. It's based on what you want to accomplish. We want to make sure that we're looking at your needs, your wants from now all the way into the future. That we make sure that we have taken care of you, that you've got the retirement income that you need, that you have the lifestyle goals that you want. If we're doing the long-term care planning, that we set aside the money that we need to, just in case you need that extra help. Then we start focusing on your family. What is it that you want to do for your family? And that's, most of the time that's, people look at that as the estate planning piece, the wills and trust, but it's more than that. It's making sure that we document what that legacy is going to be as for your family. How you want to take care of your family after you're gone. Do you want to incentivize them? Do you want to warn them against, away from certain things? But then that planning's done. Finally, when we start talking that legacy piece, the charitable legacy, do you want to do more? Can you do more? Should you do more? Those are all good questions to be asking, because we don't want to take away money that you need, passing it on to charity if it's money or income or assets that you need. But if we can stretch those dollars, if we can do that leveraging of your dollars, it just opens up more opportunity. So as you think this through, the big, as you have questions, we're going to have the question and answers. Feel free to ask questions there. If you have, personal questions or want to start asking, direct questions, feel free to reach out, and we're happy to go through all that and really lay out your options. The more options you have in front of you, the more educated your decision is going to be, and that's what we're here for.
Rick, thank you. I learned something every time you talk about this topic. That's so helpful. I love the notion of leveraging and just seeing what can we do? What are the possibilities here in this planning? It's just so helpful. Well, we're going to be holding your questions until the Q&A session on Thursday. So please hold them and write them out and send them to us, or hold them until Thursday. We'll be taking them then. And that reminds me to tell you that you can watch a replay of all of our webinars, including this one, on our website at ardenwood.org. This presentation will be available in about a day or two. So please come back. We have several upcoming events to tell you about. In November, this Thursday is, as just said, the Q&A webinar is on charitable giving, or any aspect of charitable estate planning, excuse me. Can we start over? Sorry.
Yep, it's great.
Sorry about that. Scratch that. I need to, sorry. Rick, thank you. I learn something every time you talk about this topic. It's so helpful. I love the notion of leveraging and seeing what's possible instead of just what is there, what's possible in all of this. We're going to be holding your questions until the Q&A session coming this Thursday. So please write them down. Please share them then. So we will be talking about this on Thursday. And that reminds me to tell you that we can watch a replay of all of our webinars, including this one, on our website, ardenwood.org. This presentation will be available in a day or so. So please come back. We have several upcoming events to tell you about. In this month of November, this Thursday is the Q&A webinar on charitable giving or any aspect of estate planning. And then next Thursday, November 10th, we'll be hosting our Q&A on Medicare. That's always well attended, so please make your reservation. This coming Saturday, November 5th, from 10 o'clock in the morning until noon, we invite you to join us for an online Bible presentation entitled The Law That Reveals Health, given by Evan McDonald. Evan's Bible research will inspire new views of a timeless faith. We're getting a lot of reservations. In December, our annual Christmas celebration is Sunday afternoon, December 4th at 2 p.m. Pacific. Please tell your family and friends. You can find details and register for all our online events on our website at ardenwood.org. So thank you again for joining us today. We look forward to seeing you on Thursday afternoon, same time, same Zoom link. You'll receive a reminder email with the link in it. So thank you again, Rick. Goodbye for now.